Picture this practical dilemma. You're a tax professional, and your client makes a really generous donation to a registered charity on March 31st, 2027. They hand you the payment receipt, and naturally, they confidently expect a tax deduction. But under the rigorous new compliance reporting requirements of the Income Tax Act 2025, is that deduction actually guaranteed? Well, the short answer is no, not anymore. The days of simply relying on a stamped paper receipt are completely over. Welcome to This Explainer. Today, we're demystifying Section 133 of the Income Tax Act 2025. Whether you're a chartered accountant, a tax student, an accountant, or a business owner, understanding the precise mechanics of this new section is absolutely crucial for your practice and your compliance. We're going to break down the law clearly and practically so you walk away with a complete working grasp of the new regime. So here's our roadmap for today. We'll cover an introduction to Section 133, dive into the legal provisions, walk through a quick practical example, examine the strict new compliance forms, highlight some common issues, and wrap up with our final takeaways. Let's get right into it. All right, Section 1, Introduction to Section 133. To really grasp the new law, we got to take a quick look back at where we came from. For decades, we all knew charitable deductions by one famous alphanumeric code, Section 80G of the 1961 Act. Well, under the new Streamlined Income Tax Act 2025, those provisions have been completely migrated to Section 133. Now, the core policy remains exactly the same, encouraging philanthropy, but the structural framework and the compliance mechanisms, they've had a major upgrade. Now, before we look at the specific rules, we have to talk about a massive terminology shift in the 2025 Act. Under the old law, we constantly juggled the concepts of the previous year, where income was earned, and the assessment year, where it was taxed. The 2025 Act eliminates that headache completely. Both concepts are now merged into one simple reference called the tax year. So if your client earns income and donates between April 2026 and March 2027, all related compliance is just referred to as tax year 2026-27. Simple, right? Moving on to Section 2, Understanding the Legal Provisions. Let's see how this actually operates. The main objective of Section 133 is to allow an SSE to claim a deduction from their gross total income for sums paid during the tax year as donations to specific funds and registered charities. Notice the emphasis on sums paid. This literally means the donation must be a sum of money. Donations in kind, like giving clothes, computers, or food, generally just won't cut it here. Now, the law categorizes these eligible donations into a couple of distinct buckets. Some donations get a full 100% deduction. Think the National Defense Fund or the Swachh Bharat Kosh. But there's a really vital exception you need to know. If a company makes a donation to the Swachh Bharat Kosh using its mandatory CSR funds, that specific amount is excluded. No double dipping allowed. On the flip side, we have the 50% deduction bucket. This applies to funds like the PM's Drought Relief Fund and, what you'll see most often in your day-to-day practice, donations made to standard approved registered NGOs. Okay, Section 3, a practical taxation example. Let's run the numbers to see the mechanics in action. Let's look at a super common scenario. Say you have an individual assessee with an adjusted gross total income of 10 lakh rupees for the tax year. And during the same year, they decide to donate 50,000 rupees to a registered nonprofit. So how do we process this? Step 1, you absolutely must verify that the NGO holds a valid approval under Section 354 of the 2025 Act. Section 354 is basically the new equivalent of the old registration regime. Step 2, because it's a standard NGO, it falls into the 50% deduction category. Step 3, we calculate 50% of the $50,000 donated equals $25,000. Step 4, you reduce that $25,000 from the adjusted gross total income. Boom, the taxpayer gets their relief. But wait, provided all compliance is met, which brings us to the most critical part of this explainer. Section 4, Strict Compliance and Forms. This is where the landscape fundamentally shifts under the Income Tax Rules 2026. Remember our hook at the very beginning? Well, under Section 133(6) of the 2025 Act, the law explicitly mandates that a deduction is allowed only on the basis of information furnished by the receiving institution, and it's subject to verification by the tax department. A stamped receipt from the charity is practically useless on its own now. The burden of initial reporting has shifted heavily onto the donee, the charitable institution itself. Let's map out this mandatory workflow, which is governed by Rule 190. Step 1. the donee receives the funds. Step 2. After the financial year closes, the donee must electronically file a detailed statement of all donations received. This is done via Form 113. Step 3. Once Form 113 is processed, the system generates a certificate, Form 114, which the donee must issue to the donor on or before May 31st following the tax year. Step 4. Your client can only claim the deduction if they possess Form 114 and the data reflects in their tax profile. So as a tax professional, here are the new magic numbers you need to memorize. Forms 104 and 105 are used by the NGO to get their approval under Section 354. Form 113 is the annual statement filed by the charity, and Form 114 is that final golden certificate issued to the donor. For those of you transitioning from the old law, Form 113 and 114 directly replace the old Form 10BD and 10BE. All right, Section 5, Common Practical Issues. What are the real-world pitfalls you need to watch out for? Here are the most frequent mistakes we're seeing under the new regime. First, claiming the deduction in the return without actually having Form 114. Do that and you're going to trigger an automated mismatch and a denial of the claim. Second, the charity failing to file Form 113 by the deadline, which completely ruins the donor's ability to claim tax relief. Third, not verifying if the NGO's Section 354 approval is currently active. These approvals do expire often after 5 years, and if they do, the deduction is invalid. And lastly, a procedural error, using the old assessment year terminology instead of the unified tax year on forms, which just leads to unnecessary processing headaches. Section 6, Summary and Final Takeaways. We've covered a lot of vital ground today, so let's quickly recap. Here is what you absolutely must take away from this explainer. Section 133 has officially replaced ADG. It clearly separates deductions into 150% categories, with specific exclusions like CSR funds. Crucially, the receiving institution must hold a valid approval under Section 354. And finally, the era of system-driven compliance is completely here. The charity must mandatorily file Form 113, and the donor needs Form 114 by May 31st to secure their deduction. It's a much tighter, more transparent system now. Ultimately, it begs the question, is your practice proactively updating its compliance workflows, or are you just waiting for that first automated mismatch notice to adapt? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.